As we come to the end of the first half of 2025, we recap some of the developments. This is Bode or Shosami on this episode of Global Business Insight, where we look at 7 significant trends that shaped H1 2025. The first is on artificial intelligence, as we saw the AI momentum recovering, shaken by trade barriers and the DeepSeek disruption. The disruptor can be disrupted, as we saw the AI trade jolted in the first half of the year. Chinese AI startup DeepSeek released its DeepSeek R1, already challenging rivals like OpenAI's GPT and Google's Gemini. This new version delivered major performance gains in complex reasoning, coding, and logic with its open source license and lightweight training demands. DeepSeek is proving to be faster and smarter, and most importantly, cheaper. All this was bad news for Nvidia, and matters got worse for the US AI trade as fresh trade bans against export of important AI processing components to China were announced, on top of tariffs and other fresh barriers. In February, as Nvidia sank after the DeepSeek stir, it was not so clear if its shares would bounce back. But just last Friday, Nvidia's stock hit another all-time high as it headed for a sharp weekly gain, fueled in part by U.S. Commerce Secretary Howard Lutnick saying a trade deal between the U.S. and China has been finalized, though details still unknown. It's still unclear what else can be thrown at Nvidia's stock to curb its rise, and many analysts see fresh highs in H2. The second trend is on the trade war. Tariffs or no tariffs, markets seem to be settling to new highs and the new reality. It was always expected that the Trump government will hit hard on the tariff front, but markets were unprepared for the barrage of tariffs on the so-called Liberation Day. Sentiment sank so low, fears of a global market collapse were rife as the volatility spiked, and all this amid an already tepid economic growth outlook. It was a half year of negotiations, extensions, new deadlines, threats, and compromise as markets faced the turbulence. But sentiment in the last few months of H1 recovered, also as Senate narrowly advanced a bill, voted to advance a bill that cements tax cuts and ramp up defense spending. On Friday, markets saw new record highs, despite Trump saying the U.S. is immediately terminating all discussions on trade with Canada in response to Ottawa's decision to impose a digital services tax on American tech firms. With just a week and a half remaining in this 90-day pause on Trump's Liberation Day tariffs, the White House is running out of time to negotiate its long-promised trade deals that could bring some certainty. But markets are paying less attention to the tariff drama. The S&P gained 3.2% last week, closing at an all-time high. The same with the Nasdaq. The lower volatility index also shows that markets are less worried as traders see resilience and strong earnings growth when companies start reporting in July. The third pattern was on the impact of geopolitics, attempting to roil oil and gas markets amid a supply glut. Dull economic forecasts for 2025 and the U.S. administration vowing to keep oil prices down by flooding with supply, with OPEC Plus apparently not keen to sacrifice any more market share, also returning supply to the market, implies we can expect the supply glut that dragged Brent crude to the low 60s in May to continue in the second half of the year. But then it was a first half that was not without serious geopolitical twists. A 12-day war culminating in U.S. strikes on Iranian nuclear sites sparked fresh concerns that the Strait of Hormuz will be closed, affecting 20% of crude and LNG trade. Goldman Sachs threw its previous oil price forecast out of the window, now was seeing Brent at $110 per barrel. But last week, as a fragile ceasefire was announced, prices collapsed even faster than they had spiked. Oil is back to trading on supply, demand, and OPEC Plus expectations. Now that the Middle East is relatively calm, there are 2 main price-defining events ahead. OPEC Plus with its July 6 meeting and Trump with his July 9 tariff war deadline. Also, the U.S. Geological Survey published a study stating that there are almost 30 billion new barrels of untapped oil under federal lands. Now the only question is when and how quickly these untapped resources will be tapped, and what the break-even price for investors to keep providing the capital could be. With all the vast new supply possibilities and no catalyst in sight to boost demand, Brent is seen capped in the low 60s in the second half of the year, but you still can never count out geoeconomic surprises. Then we are seeing a different piece for minerals dynamic playing out. Rwanda and Democratic Republic of Congo signed a U.S. brokered peace agreement on Friday, raising hopes for an end to fighting that has killed thousands and displaced hundreds of thousands more this year. The U.S. also hopes to attract billions of dollars of Western investment to a region rich in tantalum, gold, cobalt, copper, lithium, and other minerals. At the center of this pact is a clear geopolitical exchange, peace in return for profit. The agreement includes commitment to form a joint security mechanism within 30 days and monitor Rwandan troop withdrawal. Analysts note that the accord carries a strategic message that securing troubled nations also means securing investments. Whether that vision can override deeply rooted mistrust remains to be seen. In Ukraine, Trump insisted on a similar resources agreement as a condition for continued U.S. support, framing it as a means for Ukraine to pay back the substantial U.S. aid provided. For now, this different partnership dynamic appears on the surface to be a Trump thing, but others insist that involvement of the West in foreign conflicts have almost always been opportunistic, albeit in a more subtle way, reminiscent of neo-colonialist practices. As the economic climate becomes tougher, we can expect more open commercial instincts playing out in the geopolitics. For Africa, its interests are best served in investments which go beyond mineral extraction to more value-added processing and manufacturing activities. And Africa must also insist on best practices to protect the social and physical environment. If Africa has to give up its mineral resources, it must play its cards well to see its interests served. Populations cannot continue to languish in poverty as inequality thrives amid these deals. Then, as ECB cuts rates, the US Fed waits for clarity on the macroeconomics. We saw the Governing Council of the European Central Bank at its June meeting deciding to lower three key ECB interest rates by 25 basis points. Growth remains tepid, inflation near the 2% target, with projections showing 2% in 2025, lower than 2.3% previously. It was the ECB's fourth 25 basis point cut in 2025 as apex banks moved to shore up growth amid subdued inflation. In the UK, rates were cut twice in January and in May. In the first half of the year, we also see all over the world inflation mostly abating. Notably, inflation in Japan is rising, and most central banks were beginning to prioritize economic growth in the first half of 2025, with the exception of the US. Also, the concern that increased uncertainty and the volatile market response to the trade turmoil would have a tightening effect may be easing, albeit more gradually in the US. Klaas Knot, president of the Dutch Central Bank, says one more ECB quarter-point rate cut by the end of the year was anything but certain, as inflation risks could be impacted by the global trade war, and oil prices could also impact inflation and growth, adding that the ECB may have to hold rates as shocks play out on the medium-term outlook. The US Fed started their own easing cycle late 2024 with 3 rate cuts, but paused and kept rates on hold all through the first half of 2025, despite a slowing inflation, as it seeks clarity on policy implications of a new US administration. Trump will soon name a new Fed chair in waiting who may be less independent and expected to cut rates at a faster pace. In the US, the latest dot plot still signals 2 rate cuts in the second year, with more now seeing just 1 compared to the previous dot plot. If inflation data continues to be benign, we could see a single rate cut given the lingering mood of caution which is unlikely to be changed by pressure from the White House. In the first half of 2025, there was some momentum in advancing regional dialogue on implementing the African Continental Free Trade Area, enhancing cross-border payment systems, strengthening economic ties through expanded trade, tourism and joint ventures. But Africa still faces an annual infrastructure gap of over $100 billion, according to the African Development Bank, which needs fresh thinking to bridge. South Africa recorded foreign direct investment inflows in Q1 2025 of $662 million, though 50% higher than inflows in the fourth quarter of last year, still far from enough. The Economic Commission for Africa reiterated that stronger Africa-focused multilateral development banks are key to unlocking long-term financing. At the 32nd annual meetings of African Export-Import Bank in Abuja, which held last week, two of the world's leading thinkers on development, Professor Jeffrey Sachs and Dr. Kishore Mahbubani, urged African countries to adopt a new approach that prioritizes investment, integration, and self-belief. In the first half, new shocks seem to be derailing a nascent recovery in Africa, as Africa suffered collateral damage as the world was shaken by market turmoil, which held back capital inflows. Many called for Africa to rely more on its internal funding sources, as the venture capital ecosystem remains vulnerable to global shocks and shifts. Africa Finance Corporation CEO Samaila Zubairu says Africa holds $4 trillion in untapped domestic capital, with an additional $1.1 trillion in non-bank financial assets that could transform infrastructure and economic growth if properly mobilized. Growth in resource-intensive countries, especially oil exporters, looks sluggish at best. For 2025 in sub-Saharan Africa, growth was revised down by the IMF, down 0.4 percentage points to 3.8%. In short, Africa still needs new growth catalysts and more de-risking to mobilize and put more domestic and global capital to work. Indeed, it could be an integrated and renewed Africa's turn for a renaissance. Finally, looking at Nigeria, it was first half of improved economic governance amid lower oil prices. The first half of 2025, perhaps the best Nigeria had seen in many years, as the economy seemed to be stabilizing. This year, the World Bank expects growth of 3.7% in what would be Nigeria's best performance since 2014, save for a post-COVID rebound. The challenge is that poverty remains high and ordinary Nigerians are yet to feel the better times as the country transitions from macroeconomic correction to a more inclusive national transformation. Last week, the Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, touted achievements, including external reserves up from under $4 billion to over $23 billion. He said Nigeria is now in the third phase of its reform agenda and is now focused on accelerating investment-led growth that delivers jobs, reduces inflation, and lifts millions out of poverty. The icing on the cake for the first half was the signing of 4 tax bills into law, targeted to double tax-to-GDP ratio to 18% in 3 years, while also enhancing the business environment. In the second half, the icing could be faster decline in inflation. But still, there are 2 areas to watch in the second half of this year. First is the recent significant deterioration in security issues. The World Bank recently listed Nigeria among countries where poverty and hunger are still worsening due to instability, inequality, and conflict. Second is the external sector, as oil prices struggle well below the budgeted price. Asia-Pacific markets were higher as the revival of trade talks between the US and Canada helped risk sentiment. Canada on Sunday said it had rescinded its digital services tax in a bid to advance trade negotiations, bowing to pressure from Trump. That's it on this special edition of Global Business Insights. Thanks for watching. Bye-bye.